There was always this idea that pre-construction condos were a bulletproof investment. Not sure if you know this, but people used to buy them with less than $100,000 as their down payment. Then over the years, when the building is finally built, it was common for those buyers to see equity increases of 3 or 4 times their down payment, which is why a lot of investors would buy pre-construction condos. In today's real estate market, pre-construction condos in several parts of Canada like Toronto and Vancouver are considered high-risk investments, something you would have never heard anyone say 10 years ago. The reality is that the real estate market fluctuates, and this time around, it's been for a couple of years. Investors outside of Canada would also take advantage of the booming condo market, even if they had to make higher deposits of 35%. And even at those percentages, it was hard for wealthy international buyers to ignore the potential to grow their money by 3 or 4 times in a few years. It got to a point where real estate agents would focus only on the lucrative pre-construction side of the business, and focus even more on the international side of it. They would fly out to other countries like China, for example, and share the new Toronto pre-construction condo projects with them. After breaking down the numbers and sharing why they're solid investments and how much their money would actually grow, this eventually led to rising home prices. But now the market is slow and investors are not looking into this anymore in the way that they used to. So this means the condo market, and specifically the pre-construction condo market, is heavily dependent right now on local Canadian purchasers. And in this economy where literally everyone is struggling financially in one way or another, buyers are no longer looking into pre-construction condos. And keep watching, because I've got updates for the new condo being built at 8 Wellesley Street West. If you've been following me on YouTube, then you know that I've been sharing my journey about the specific pre-construction condo unit that I bought. I'm in the same boat as a lot of other people. I'm closing later this year or early next year, when I go straight to final closing and skip the interim occupancy phase. The problem is that I could be scrambling to get a mortgage. My income needs to be high enough to qualify, so in this video, I'll share with you the risks that I'm facing and also some examples of what happens if you can't close. What happens to your deposit and what creative ways can you use to close the deal. The reason why I'm doing this is because I don't think there's enough transparency out there that talks about the risks and struggles when it comes to buying pre-construction condos. And in today's market, there is a lot of risk. I remember when I bought this place and I thought I could generate a lot of equity while waiting for the building to finish construction. Because back then, you could take your money and quadruple it in 4 or 5 years without doing anything else other than waiting for the project to finish. This was one of the quickest ways to build your wealth through real estate. Down payments were manageable through a deposit structure that was spread out over the sales and construction period. Typically, you'd have to put down a 20% deposit, which ultimately became your down payment. People knew about these potentially massive equity gains, and this was going on for years. It created this boom in the pre-construction condo market sector, and consequently, the resale market. Because in the end, investors would cash out, sell these 1-year-old condos, then move on to the next project, and repeat the cycle. Toronto and GTA home prices are no longer rapidly going up. In fact, condo prices are down 1.5% overall compared to just 1 year ago. Sales have fallen as much as 71% in some areas. If 5 years ago someone purchased a pre-construction condo for $600,000, the market value has likely come down since then, and that's what's causing trouble for pre-construction condo purchasers. Market values have come down so much, interest rates are so much higher than 5 years ago. If the market declines, the value of these units also drop. This makes it harder to get the remaining 80% of the property's value financed through a mortgage. It also makes pre-construction condos a less attractive investment. There are 2 risks that you could run into. Pre-construction condos are known for their construction delays and lately also cancellations. This could also happen because of labor shortages and increasing construction costs, or even developers running out of money to complete the project. Over the last few years, there have been several Toronto condo projects that went into receivership. This is a process where a receiver is appointed to manage the company's assets and business operations. The existing company in charge can no longer sustain the financial burden of the project and is putting the project at risk. When a project goes into receivership, it creates delays to the construction timeline and overall completion date, which means the project closes later than originally projected. One project in Toronto that went into receivership was all over the news. The one located at 1 Bloor Street West was supposed to be completed this summer. It's directly across the street from 1 Bloor Street East. That's a 75-story tower built in 2017. This building has over 700 units, some that are bigger than luxury detached homes with more than 5,000 square feet of interior living space. But the new building across the street at 1 Bloor Street West was supposed to be about 82 stories with around 400 units. Some of them would almost be about 6,000 square feet of living space. That's about the size of 10 average size 1-bedroom condo units. Some of the units were priced at $31 million during the initial launch period. In the resale market today, they're still trying to fetch $35 million. But in today's economy, where construction costs have gone up nearly 40% in the last 2 years, financing costs have tripled. This eventually slowed down construction. This is what it was supposed to look like today. Here's what it actually looks like today with about 50 stories built. After going into receivership receivership with $1.6 billion in debt. It was finally taken over by a construction company called SkyGrid. Makes me think of Skynet, which took over the planet, so it's not really the same thing. It just sounds the same. The one at 1 Bloor Street West has no completion date yet, but I'd expect it to take several more years to complete. You hear stories all the time of abandoned buildings around the US for similar reasons. They just get left incomplete and abandoned. This one in particular was a $1 billion project abandoned in LA by a developer in China that ran out of money. If you're ever at a Lakers game, you can probably spot the tower. You really can't miss it with all of that graffiti and damages that's going to cost the city almost $4 million to clean up. Some residents in Toronto think that we're headed in the same direction, and I get where they're coming from considering the number of projects we have going on in the city right now, and also the number of project launches that have been put on hold. There are currently 1,200 condo projects in various stages of pre-construction around the GTA. Yet right now, developers know it's not the best time to build. Development costs are high, buyers are not buying, and there's a slim chance they could actually reach the sales target of 70% to start construction. Seeing things like this is what makes me worry a bit about the pre-construction condo market. I didn't have this kind of worry 5 years ago. Like I mentioned, I'd share with you some updates of where I'm at with the pre-construction condo that I bought at 8 Wellesley Street West. If you haven't already, check out the playlist in the card up top where I talk about the construction progress about the condo project. I also share my own personal experiences ever since I purchased the unit, learn about the process of buying a pre-construction condo, making deposits, choosing the right floor plan, whether it makes sense to buy condo parking and a locker, and so much more. I'll also be shooting new episodes for this playlist when the project comes closer to completion so that I can share the entire experience with you. So far, I'm lucky that this project has been going smoothly. Every time I pass by downtown and see this building, it really amazes me to see how much it changes in just a short period of time. Structurally, construction is completed up to the 55th floor, which is the top floor of the building. The roof was being worked on. I could see more work being done on the ground floor. I still remember there was another project in Thornhill I was considering. I passed by that one the other day and they were nowhere near being complete, and both projects launched at the same time. I was talking to a mortgage agent about the appraisal value for this unit because I wanted to get an idea of what it's worth in today's market from a lender's perspective, but I couldn't get a straight answer, so instead I looked at comparable units in the same area. New buildings, 2 bedrooms, 2 bathrooms, no parking or locker, which would have cost me $200,000 more, and about 700 square feet. So to my surprise, it actually looks like the price is close to the same thing that I bought it at, or even higher by about 10%. And that's in this market where home prices have come down. So when it comes to getting my mortgage next year, I'm not too worried about the appraisal value. If the appraised value is lower than the original purchase price, then you start running into some problems. Let's say it was purchased for $600,000 5 years ago. A 20% deposit was made. That's $120,000. And just so you know, a 20% down payment is favorable when you're trying to get a mortgage. It gives you more opportunity to get a lower mortgage rate, and you also avoid mortgage insurance premiums. Today, let's say the appraised value is down $50,000. So the appraised value is $550,000. Here's what people are doing in scenarios like this. The lender approves the purchaser with a down payment of 10% of the new appraised value. They originally had 20% as a deposit, but the lender gets creative and only utilizes 10% of that original deposit. 10% of the new appraised value is $55,000. So that $55,000 becomes the new down payment. The lender provides a loan for the remaining 90%. The original purchase price was $600,000 and today's value is $550,000. The difference of $50,000 still needs to be covered because unfortunately, even though you already got your mortgage, it doesn't magically go away. From the original deposit of $120,000, $55,000 is used for that 10% down payment. From the original deposit, there's still a balance left of $65,000. That extra $65,000 in cash is enough to cover that $50,000 difference between the appraised value versus the original purchase price. There's still an extra $15,000 that goes back to the purchaser in the form of a check, or the purchaser can also put that towards the down payment to help reduce their monthly payments. And this is just one example of what pre-construction condo purchasers are running into. There are many cases where the purchaser has to cover even more from their own cash if the appraised value comes back extremely low. Scenarios like this are getting a lot of purchasers scrambling for cash to close the deal. In another example, if the appraisal comes back at $500,000 on a unit that was purchased for $800,000, then the purchaser needs to find a way to cover the difference of $300,000. No one has $300,000 lying around, even if they had 5 years to save. And even if they did, they're pulling resources and setting themselves back in other ways just to make this happen. This is why we're seeing a lot of assignment sales of units being sold at a loss. Purchasers are choosing to assign their purchase agreements to a new buyer. They're essentially selling the condo before they take possession. They avoid closing costs, land transfer taxes, legal fees, and maybe even get a free assignment if it was in their original contract. They also avoid buying a condo unit that they could no longer afford at current interest rates that are more than double what they were 5 years ago, because they originally bought these condos when interest rates were almost next to nothing. Today, a lot of these assignment sales are being sold at a loss. Taking a loss is cheaper than closing the deal with a higher mortgage payment, with higher interest rates, paying mortgage insurance premiums if the down payment is reduced to less than 20%, and also coming up with the extra cash to make up for the difference in the new appraised value. The buyers that are in the biggest trouble right now are the ones who bought in the last 2 years and are closing this year. They likely purchased sometime way after the initial sales launch, bought a unit from the developer's remaining inventory that was being sold at a premium. Market values have come down since then and mortgage rates have gone up. In the next 6 to 12 months, I'm expecting some major updates from the developer at 8 Wellesley. So be sure to subscribe to my channel if you gain value and if you want to follow for more on the process. There will be videos on the interior design and material selection, pre-delivery inspection before taking possession, and I'll even be able to share a walkthrough of the building. Because believe it or not, just because you get the keys and you take possession of the unit doesn't mean the building is 100% complete. So if you want to see these updates, subscribe and follow, and I'll see you in the next video. Thanks for watching.